Welcome back. I'm joined by Keith Hobart with Peak Mortgage again. And today
Grab it, Joe.
going to talk about, yes, great to have you here. We're going to talk about FHA versus conventional loans, probably one of the most basic mortgage topics in the world.
Yep. But it's a very important one, right? I mean, those are the two primarily, it's the two most primarily used mortgage loans out there. Let's get into details on the differences between them and why you should go with one over the other one.
I dive right into it. What would drive a buyer to one or the other?
Yeah, typically it's going to be credit score related, and your debt to income ratios. Those are the two primary forces that drive people into FHA over conventional. And what I mean by that is with FHA, mortgage insurance is a flat percentage. It doesn't matter if your score is 580 or 800, it's the same amount. Or on conventional, if your mortgage insurance is all risk driven, so it's based off a credit score. So the better your credit score is, the cheaper your mortgage insurance is. So if you have less than stellar credit, a lot of times we'll go with FHA just because your mortgage insurance can be a lot cheaper. I've seen mortgage insurance with people within that 620 range be very, very expensive on conventional, like extremely, extremely expensive, unfortunately. The other option is FHA is a lot more lenient on your debt to income ratio. So I can go a lot higher on your debt to income ratio theoretically than I can on conventional. And so those are the two primary reasons that we would pick FHA over conventional.
Correct me if I'm wrong here. I've always kind of told my buyers that in general, conventional loan is where everybody kind of starts or looks to, unless there's a compelling reason to go with FHA.
Yeah, typically. So, I mean, there's never really any kind of preconceived notions when you meet with somebody. I've talked with people that you would think were really, really squared away and they weren't. And I've talked to people who you would not think they're squared away at all, and they have perfect credit, no debt, and that sort of thing. So you never judge a book by a cover in my industry. And so, yeah, we do as soon as we pull credit and see kind of where your credit score is at, that'll quickly kind of determine which path is going to be the best way for them.
That makes sense. And then speaking of that, I guess the most basic question, what are the credit score requirements for each program?
Yeah, every lender is out there is different. I do have some lenders out there, some mortgage broker options that we can go pretty low. On average, it's about 580 for FHA and then 620 for conventional. So that's kind of a general rule. Again, every lender is different, but those are two of the most common ones.
It's crazy to see 580 score.
Just because
fluctuate too, right? I mean, or they can fluctuate based on risk and, timing, like what scores are this year.
And just because we pull your score right now and you're at a 580, I've seen some really easy opportunities for people to get their score up by doing a rapid rescore, which just means I'm gonna kind of analyze your credit, run you through my system, and see how we can get your score up quickly. And so just because you're starting on this point right now today doesn't mean that that's where we're going to finish. So
right, that's another good reason to start talking to somebody early.
Sooner the better. Yep.
Get your credit score figured out and then see if you can, obviously you can do a rapid rescore pretty quickly, but sometimes it just takes some time to get some things done if you need to make some, pay off some things or something like that.
Yeah. If home ownership is your goal in the near future, definitely the sooner the better. Because I've seen people wait until they're actually ready to buy, or they think they're ready to buy, and then they're still 6 to 12 months out. And so if you're unsure of your scenario and kind of what you need to do, definitely the sooner the better. Go out, talk to a mortgage professional, and make sure that you have all your steps squared away, that you don't need to start out something right now today, whether it's credit score or paying down debt or whatever it may be. So
that makes sense. And we talked a little bit about mortgage insurance before. What obviously, you said that the FHA is just a flat rate. Is there anything people need to know about with mortgage insurance? Or typically I've always just said, let your loan officer just when they can pick, they're going to pick you the best one, and when they can't, it's just going to be what it is. Is there anything people need to know about with that?
Yeah, great question there, because there is a big one on FHA. So unless you put a whole bunch of money down, your FHA mortgage insurance is on there for the life of the loan. In a conventional setting, as soon as you get to that 80% loan to value ratio, 78% where it'll automatically fall off, FHA will be on there for the life of the loan. So definitely be in mind of that. I will say a lot of times it doesn't necessarily come into play because you're going to be refinancing or selling your house before it would fall off anyways.
Right.
But that's the big difference between those two loan programs.
That makes sense. And then, talking about that, I guess mortgage insurance, just to clarify, generally only comes into play with down payments less than 20%. Correct. If you're over that, it's not a concern. It's really just if you're under that. But again, a lot of people think that you have to have at least 20% down, and you don't.
No, definitely not.
You're just going to have mortgage insurance.
There's some people out there, very well-known financial advisors that say to buy a house with 20% down, and I definitely don't agree with that. That sentiment, because I've seen people do that and they waited on the sidelines for sometimes 5 and 10 years to save that money up, and they just missed out on so much equity that they could have got during that time. To where we do a lot of down payment assistance loans where people are coming in with very little out of pocket, and what that does to their long-term wealth is exponentially greater than had they been sitting on the sidelines trying to save up that 20%. So
definitely. And I think, maybe in certain areas where the values aren't going up so high, maybe it's not quite as big of a deal. But here, prices are high and the values are going up so much. Like you said, I mean, a lot of these homes are making $100,000 a year in equity.
Yeah,
you might as well make that versus, how long is it going to take you to get to that 20%? If it's going to take you more than a few months, you're losing.
Exactly right. Yeah.
And then FHA and conventional loans, what about using them for, or can you use both, or either for investments or for second homes?
Yeah, FHA is going to be just primary, and there is a chance that you could use two if you got moved, relocated, or something like that. It is generally harder to have two FHA mortgages at one time, though, but it can be done. Conventional just depends on the down payment. So 5% is generally the minimum down that you're going to do on a primary, 10% on a second home, and then ideally you're putting 20 to 25% down on an investment property going conventional.
Gotcha. One thing that I do hear once in a while is people say, "Oh, well, yes, of course I'm going to live in it," but they don't actually intend to move into it. And they, I've had some people, "Oh, I want to get this great FHA loan, but I'm not really going to live there. I'm just going to." Yeah, I am. What are the risks with that?
Yeah, I mean, the risk is if the lender found out, I mean, you are technically committing loan fraud, and they could call your note due. So, I mean, there's definitely a risk with that. I mean, there's times that I know people have done it, and I'm sure that they've gotten away with it. And so it's one of those things. I'm definitely not going to encourage it by any means. But just keep in mind that you are committing loan fraud by doing that. You're basically stating like, hey, that you intend to live in this house. Your intentions are you're going to live in this house for the next 12 months when you buy it as your primary. Obviously, there's instances that come up, job changes, divorces, things like that can change that. But if you buy as your primary and never move into it, then obviously you know what your intentions were. So
yeah. And then interest rates between the two, between FHA and conventional, where do they hover? How do they compare?
Yeah, generally, again, every lender is different, but kind of stereotypical speaking to the whole rates on an FHA loan are going to be a little bit lower. So on average, I'm going to say a half to maybe 0.75% better, depending on your credit score. But that's one nice thing about the FHA is you do get a little bit better credit, a little bit better interest rate than you do on a conventional loan. It just has to do with basically the risk on that and HUD backing those loans as opposed to being an open market type thing is why conventional is going to be a little bit higher.
And that's why you have to compare them, because that FHA, then you're adding the mortgage insurance in, which can flip that exact calculation around.
Yep.
So something that does come up a lot, especially when agents, when we're selling homes, is condition.
Yes.
What do we need to know? This could be a whole hour-long lecture, I think. I know as an agent, it's just something we come across all the time. If I have an FHA client, like we have to make sure we're looking at the home to make sure it's even going to get there. But any kind of pro tips on that?
Yeah. So conventional loan, I mean, most of those houses are as is, right? Like I've seen some really, really rough shape houses that conventional doesn't care. As long as that house is worth what they're paying for it, that's all that matters. Appraisers are not getting down there and making sure the house is in decent shape. FHA, if you're going with an FHA loan, it's going to be much more looked upon in terms of the overall condition of the house. It definitely doesn't replace getting a home inspection, but their job there is to make sure that the big ones there's no health and safety potential issues with the house, right? So no exposed wiring, the deck's in decent shape that you're not going to fall off the deck. By far the biggest one is chipped and peeling paint. So just know that. So, and a lot of times too, sellers, if it's just chipped and peeling paint, a lot of times they'll work with you and they might do that stuff during the escrow period to get it done so the house can go that way. But even if there's a shed out back, that's part of the transaction, that shed can't have chipped and peeling paint too. So that's That's going to be the big one right there.
Yeah, just watch out for the bigger issues. I know roofs are usually something we
Roofs.
kind of talk about, like conventional. As long as it's got a year left in it, they'll let it go. And FHA now seems like 5 years is kind of a standard.
Yeah,
a little less, but
generally they want about 3 years plus on a conventional. FHA is gonna be they're a little bit more strict on that. And so if you're unsure, definitely talk to your lender. A lot of times, if you just send them the listing, they can give you pretty good advice on whether they think that'll go FHA or not. It's not guaranteed because there's a lot of times there's stuff behind the scenes that obviously we don't see. So
yep. And we don't always take photos of everything that's wrong with them.
Exactly.
And last on the list, what are the comparisons between FHA and conventional loans as far as closing costs and just overall affordability? Any pitfalls people should watch out for there?
Yeah, the big one is upfront mortgage insurance premium on FHA. So there is an upfront fee that FHA charges. 99% of the time it just gets added to the loan amount. Very rarely do I have people that pay that as part of their closing costs, but it is something that's going to increase that loan amount. While you may be putting 3.5% down, your actual loan to value ratio is going to be a little bit higher than that because of that mortgage insurance premium. Other than that, they're going to be relatively the same in terms of closing costs and that sort of thing. So
where somebody might pay that up front, it seems, I guess just thinking about it, seems to me, my instinct would be, you don't know how long you're going to be in the house. If you're not going to live in it 30 years, you might as well, if you're going to sell it before 30 years, you might as well just do the monthly payments added in and do the monthly.
Yeah. But in my opinion, it's kind of 6 in one hand, half dozen in the other. A lot of times if we're going FHA, it's for a reason where the customer doesn't have a ton of down payment options. And so, or a lot of down payment money to work with. So that's where it just automatically gets added to the loan. And just typically that's the best route to go.
Cool.
Or the most common route to go.
Yeah. Well, that's all the questions we have. Appreciate you taking the time today. And look forward to having you back.
Thank you, Joe.